Bank of America warns that stocks could crash another 30%. I'm Steve Van Metre. Bank of America sounding the alarm as markets teeter on the edge of collapse. Panic's brewing fast, and you won't believe what's hitting the markets on Monday. Plus, we're going to look at the technicals, momentum, and machine positioning to show you where the risks and opportunities of this market lie. And am I about to make a recommendation to buy Bitcoin? This is one show you don't want to miss. Stay tuned. Now let's head over to Bank of America, where we find out that their S&P target is now at 5,600, but the problem is it's got a wide range, meaning it could drop to as much as 4,000, as Bank of America says, by large cap over bonds. As Bank of America revises their S&P 500 2025 year-end target to 5,600, but what happens between now and then, because we're only in April, a floor of 4,000 on the S&P would represent about a 35% decline, slightly worse than the typical recessionary decline of 30%. 7,000 would represent a rally of 40% from here, roughly half of the post-COVID rally and roughly two-thirds of the post-GFC rally off the bear market lows. So what Bank of America is clearly telling you is we don't know what's coming, and we're facing some serious risk here that could plunge us down another 30%, bringing the S&P to 4,000, but something could change and drive it up. But by year end, we're not going to be far off from where we are now. And let's take a look at how they put their model together. They looked at their 2026 EPS model, assuming for inflation, equity risk premium, and a fair forward PE. They come to a fair value by year end of 5,400, slightly higher than where it is right now. But there's some other risks as we go into Monday, and that is that earnings season started last week, and now we're starting to get into some heavy weeks of corporate earnings. And based on BofA's framework, they estimate direct impact from China tariffs and retaliation is roughly 15%. And this means that companies are going to shut down guidance amid uncertainty, and that's going to take another hit to earnings, suggesting that the risk to the market is not to the upside here, but squarely downside facing the Bank of America's 4,000 target. But here's what I want to know from you. Do you think that is a possible outcome? Do you think stocks could get down to 4,000, or do you think this is the bottom and we're going to head all the way back up to 7? I want to know. Weigh in the comments below, because based on the ISM Services PMI, we're looking at a 4% EPS growth, and that is below consensus forecast, a dangerous sign suggesting that, again, what we could see is a sell-off in the broad equity market as companies miss their earnings expectations. But one of the best signals to look for if you're looking to find a buy opportunity is breadth. And we're going to look at that today. But on Monday, 76% of the MSCI All Cap World Index traded below its 50 and 200-day moving averages, close but not quite, triggering a buy signal from their global breadth rule, which is triggered about at 88%. We are long two-year treasuries, short the S&P 500, saying you should sell the rip and risk assets until either the Fed cuts and breaks a liquidation cycle of higher yields, lower stocks, and lower dollar. And right now, the Fed's saying we're on the sideline, so no sign of that happening, or that the U.S.-China trade war eases into a reverse recession momentum, or the U.S. consumer purchasing power rises via real wages, and that's highly unlikely given that many consumers are now worried about losing their job. That means, of course, we're going to see income growth decelerate. We're going to see hours cut and people stop spending in a big way. But while retail investors are buying the dip, foreign investors are selling U.S. equity funds at one of the biggest and fastest rates in history. But Bank of America says, look, this isn't the time to buy. As we look at their bull and bear indicator, it's sitting at 4.8, meaning it's nowhere near the extreme bear level that you would need to signal to buy back in this market. Again, why they're saying you should sell the rips and buy something else. We'll show you what you should be in here in a little bit. But let's talk about CTAs and machine positioning, because right now they're short 31 billion of U.S. equities, but still long 16.5 billion of global equities. Goldman notes this cohort as sellers in every scenario over the next week and month. So what we're seeing from machine positioning is they're heavy short the U.S. indices, meaning a little bit of a rally could turn them around. I'll show you that here in a moment. But one of the other things we're facing is corporate share buybacks are going to be in the blackout period over the next few weeks and can only rely on their 10b5-1 plans versus placing discretionary orders. Of course, the biggest risk to the market is what we're going to find out is that corporates are worried and they're going to cut back their buyback plans to hold cash. If that happens and the biggest buyer of stocks starts to back off, watch out. BofA's case of 4,000 on the S&P could become real. But Goldman notes over the next week and month, what we see is selling in global equities with a little bit of buying in the S&P. You could see 1.7 to 2 billion, and that's virtually nothing. They note some key pivot levels. Let's take a look at a chart of where those are at, just so you have some perspective on where the machines could be buyers here. You see that orange line? Well, if it crosses that, you're going to see some short covering. The risk here is, will earnings be strong enough? Is the 90-day suspension and tariffs going to do it that gets the machines to buy here and create a short-term opportunity? Or are we likely to see a rally and then a reverse there? Bank of America, Goldman, not looking too hopeful that either of those scenarios plays out, because right now, when you look at retail, that's non-dealer in U.S. equity futures positioning, people are long and extremely long, leaving a little room for people to buy back into this market. On Friday, Goldman noted that the S&P E-mini top of book depth is the worst it's ever been, ticking below 1 million on Friday, meaning if you were trying to sell anything bigger than $1 million of S&P 500 futures, you're going to move the market. There is a high lack of liquidity here, suggesting if money floods in, we could see a very large move to the upside, or if we see sellers dominate early next week, you could see some large moves to the downside. Until liquidity was restored, markets are going to be extremely volatile. But let's take a look at the S&P 500. Let's start looking at breadth here. And what do we see? In a normal case, this is a tremendous buying opportunity, but we may not be there just yet, because right now only 28% of the S&P trades above its 200-day moving average. And in historical times, we can go back and look. It doesn't mean this is the bottom, but it suggests we could be close to a bottom if this is simply a correction in the midst of a bull market. Of course, I'll leave that question to you for the comments. Is this a correction in the midst of a bull market, or are we in the beginning stages of a bear market? Weigh in the comments below, because if we're seeing more downside risk, then we want to wait until this gets down to a 3 standard historical deviation move. Let's talk about how the S&P's position now in terms of momentum. It is clearly negative. While the RSI is up to 44, the MACD has a very deep negative cross. Our own Momentum Timer Pro logs 36 consecutive daily sell signals. Now, if you're trying to trade momentum here, one of the problems is you see oversold conditions lead to further oversold conditions, and that means price can go down. So what we do is we overlay trend with the momentum signals to increase the accuracy of that. Now, if you want to trade momentum, I'll show you how easy it is, because right now we have 36 consecutive daily sell signals and a fat sell max on our 1-month window. Until this reverses, we're telling our momentum traders to hold off. Now, if you want to trade against the machines, you notice we have a fast and a slow algorithm saying the S&P machines should be sitting at max short here, and they indeed are, and we led them on that direction down, because unlike the machines that trade short-term periods, we look at historical overlays, so we know where they're likely to go before they even get there. Now, let's take a look here, because our upside target is 550. Downside 493. Let's hit the charts and see what's going on with the S&P 500 here as we now zoom to the SPY, largest traded ETF. Upside target very clearly, that's a 21-day moving average. You see it's been following the 9-day down, breaking up to the 21-day and then coming down. Right now, a ton of support down here in the low 490s. That's our downside target to suggest that to where it hits. Upside target is, again, that 21-day moving average. You see momentum pushing up here, but is it strong enough to defeat what could be a very ugly earnings season? We'll find out soon enough. Let's take a look at the NASDAQ 100 again. So just like the S&P 500 is suggesting a potential buy opportunity here, as 32% of the NASDAQ trades above its 200-day moving average. But what we can see is it usually gets a little bit worse here. And with tech companies in blackout and likely going to be hammered by the tariffs, we're going to hear from them in their earnings in the not too distant future. The question is, are these big tech companies going to continue buying massive amounts of their stock back? That is the question. If they back off, watch out. There's definitely more downside risk to this market. Here we can see QQQ RSI positive territory at 45. MACD's got a negative cross. Momentum Timer Pro saying not yet. The trend here is not validating any upturn in momentum, so be very careful if you're trading this. We log the machine positioning is at max short. That validates exactly what we're seeing from Goldman. As we flip over and take a look at the charts here, where we see a similar story, that again, it came down to this level right at the low 400. And let's zoom out and you can see it just tagged support there, but the real support is down below around 367. So keep in mind, we could see further downside moves here, as this has been a heavily bought dip by retail. And what are we noting from institutional and professional investors? They're selling the rip. This is what B of A is telling people. If it goes up, sell it. And if we see a reversal here, well, for a lot of these retail investors, it could cause them to panic and hit the sell button and push stocks all the way down to this 367 mark. So keep in mind, our downside risk is still in play. But if you're looking for opportunity right now, you heard from Bank of America, they said focus on large cap value. My focus would be right here on small caps, and here's why. Only 15% of the Russell 2000 is trading above its 200-day moving average. Historically, it's not exactly the bottom, but it's darn close to it, suggesting that this is what you want to watch. You want to look for a bottom in small caps here, because this is where the opportunity is. And let's take a further look. Momentum is negative. The RSI still in negative territory at 38. We want to see it above 40 and rising. MACD's got a negative cross. The trend is very much down. We see a max sell signal on our 1 month and 38 consecutive daily sell signals. Machines here, max short again, all across U.S. equities. Upside target, let's see, 196. Downside is 171. Let's take a look at where IWM can go. And wow, what do we see? A major sell-off here. Look at this. This is this 2-year volume profile. You can see what happens when it breaks that. Well, that means all these people that were buying underneath here, they got stopped out. They wanted to sell, and sure enough, that's driving price down. Now let's move out to the 5-year chart, because there's still more downside potential to this. If it gets down to 163, what do you see? Major support all across here. This is where you'd be looking to buy. So right now, this is something that should be on your watch list. Maybe not necessarily what you're trading, but keep an eye on small caps. Now let's talk about the energy sector, because right now prices are nosediving. We look at the headlines, we see U.S. crude closes below 60 per barrel as the sell-off continues during the trade war. That's right, as demand from the broad economy falls, the usage of energy goes with it, and that means prices go lower. So is there opportunity here? Well, let's take a deeper look and see if we can find it, because again, momentum's negative, and we saw energies just sell off like crazy. Again, machines max short across the U.S. indices. That would imply that they're also short in the energy sector. Upside target's 82, downside target revised slightly lower to 74. Let's take a look here what the charts have to say about XLE, because I think there's going to be opportunity here, but not just yet, because when it comes to energy, there's something you really have to know, and that is the insiders. They manipulate and trade this to make money. So when they're selling, you want to be out of this, and when they're buying, you want to be in it. So let's take a look at where the insiders might be buyers here. Probably not until it gets down to right around 70. You can see this is a point where there's been buyers just at around 70 and just below. So this is looking at a 5-year chart. So again, opportunity in energy, not there, because it starts to look like a topping pattern. How do you know it? Because every time price got up in around the $92 to $98 range, what happened? The big players were dumping, and that means they want to see price come down so they can buy back in. So hang tight on the energy sector. We think there'll be opportunity there, but not just yet. But the question is, why are bank stocks falling ahead of earnings? Well, because liquidity crises are not bank friendly, my friends, not remotely friendly. As we take a look at XLF, and what did we tell you weeks ago? Don't get in the financial stocks. Remember, it started to go up to all-time highs. We said, do not chase this. Don't trade this. This is going to reverse. Sure enough, it did. Momentum is negative. The RSI is at 44, negative cross in the MACD, but the trend not validating that uptick in the RSI. 7 consecutive daily sell signals for Momentum Timer Pro. Machines are short, no surprise here. Upside target 47, downside 41.11. I think the downside target is far more likely to be in play. Now let's switch over to XLF, zoom into the 1-year chart, and I'm going to show you that 41.11 level. There's your volume profile line on that 1-year chart. That's your downside risk, because up here you see these 2 purple lines. It's called a supply zone. Now what does that mean? That's where people have been buying or people want to sell. And you can see buyers stepped in here, but sellers were above. Now it rallied back right up into there above the 200-day moving average. You can see right here what happened. Sellers were there. So what's likely to happen? Price potentially rising into that zone. If you see sellers emerge, watch this thing to come down to 41.11. That would be the place if you're looking to buy. That's where you want to find the price to be. Let's talk about Brazilian equities. We actually made a bunch of money on this and maybe setting up to make some money again. again. Momentum right now is negative. We see 6 consecutive daily sell signals. Machines here are max short on the fast algorithm, but not all the way short on the slow algorithm. Let's take a look because we see downside at 2281, but the upside target is looking kind of interesting. Now, do I think this is exactly the time to buy Brazilian equities? I don't. But I think we're getting close. So zoom in here to the 6-month chart. And what is the risk here? It's following its 9-day moving average down. Overhead resistance, that blue line, that's a 100-day moving average. And right above that, 6-month volume profile. So I want to see a little bit of a pullback, maybe down here to 2281. And then I would be looking at a reversal all the way up to 2687. That's what I'd be targeting. So put that one in your pocket as well. But remember, the experts said to buy emerging markets, and we said no. But they're saying it makes Bitcoin look calm. Well, should we be buying Bitcoin? Stay tuned, I'll show you. How about EEM? Right now, momentum is negative. RSI is sitting at 45. MACD's got a negative cross, and we said this was going to go down, and it did. And look at this, machines are max short. No surprise, the trade war is not friendly to emerging market countries. Let's take a look at the chart here because it did something very, very interesting, and I want you to see what happened. Let's take a look at the chart because there's something very interesting that happened, and we have to zoom out to the max weekly, and it tagged. See this shaded zone? This is Steve's line of doom. If it breaks this, you're into a crisis scenario, and it came down and touched right above that. As we'll zoom into the 6-month chart, buyers stepped in here. It rallied up to its 9-day moving average. It's got some movement, maybe up here to 42.33 with a little bit of luck, 43.11, but I'm not confident that this holds. We'll see what happens here going into next week as earnings start to come out. I think it's going to be ugly. But remember, Bank of America said to buy the long bond. Well, that trade got torched as hedge funds sold. Now they're saying buy the 2-year. Let's take a look at TLT. What do we find? Momentum here is negative. Now, we got stopped out because remember, we had all those trades that said, look, we're going to put stop loss on this, and we got stopped out 2.82%. We're going to look to reload this position because I think there's going to be some opportunities because look at this. On the fast algorithm, it's been selling down. Momentum now, 5 consecutive daily sell signals. So what's happening is all of this hedge fund liquidation is getting the machines to sell and build short positions. And this is great news because at some point, the basis trade is going to return. Liquidity is going to come back in the repo market. And what are the hedge funds going to do? They're going to buy. And that means machines have to short cover. And means momentum is going to turn up. And that means, my friends, opportunity is going to knock. But that day is not today, but it could be coming soon. We'll keep an eye on this trade. But let's take a look what happened. It traded down near its 6-month lows. But notably, there have been buyers stepping in here to hold support. But does it mean the hedge fund selling is over? It doesn't. But when it does mean it's over, we're looking at a large move coming out of this up to 92.04, particularly as these machines build short positions. And then the hedge funds, again, if the repo market starts to come back where there's liquidity, the hedge funds are going to be back all over this trade, squeezing machines and driving price higher. So opportunity potentially knocking for the long bun, but again, we're not there yet. Let's talk about gold because everything is headed higher. It broke to new all-time highs. Machines are long, momentum's long, but what did our subscribers do? They jumped on the junior miners. Momentum here is positive. RSI now stretched at 70. So what did we tell them to do? We simply said, raise your stop loss levels here because yes, gold can go higher, miners can go higher. And when you make a 9% return in 2 days, one thing you want to do is hold on to as much of that as possible. But let's talk about the dollar and then that potential trade on Bitcoin. What's going on with dollar? Well, it's getting obliterated here. 48 consecutive daily sell signals, and you see machine positioning max short. You see, of course, momentum is heavy short across all time horizons here. Let's take a look at the chart. I think the dollar goes even lower here, which is a major risk, of course, to the broad equity market itself. But let's zoom out to the 2-year chart, and I think the dollar here, you broke that 2-year volume profile line. I think you've got every bit of a run down here to about 27. There's not a lot of support. Even if we zoom out to the 5-year chart, you can see the next level of support. Well, it's right where it's at now. You break that, you're down here to 27, and that's where you're going to find potentially the most level of support before it hits the supply zone in the high 26 range. But what about Bitcoin? Well, was I joking when I said it may be the opportunity to buy? The answer is no, because on Monday, we have a buy it open for our Momentum Timer Pro subscribers. We saw one daily consecutive flip on momentum in our buy signals, and that's telling us coming off of this big sell max window, based on our historical modeling, there is potential opportunity. So let's take a look at GBTC. This is the Grayscale Bitcoin ETF Trust. And let's zoom in. And what do we see? It held support at its 200-day moving average, not once, but twice. It did break below, but it came back up there. Now, all of a sudden, the 21-day moving average starting to bottom out here. Let's zoom in, and what do we find out? On the 10-day window, there's buyers underneath here. There you see the volume profile. All this is buyers underneath. Let's zoom out to the 30-day window. Buyers underneath. How about the 90-day window? Well, we see the line above that, meaning that's where the price is likely to move up to around 76. Again, we are putting this signal on, telling our subscribers, if you can believe it or not, it's time to buy Bitcoin. So what we're faced now with Bank of America is we could be in the beginning stages of an all-out bear market, plunging stocks, if you can imagine, down to 4,000. Create a lot of opportunity, which is why we're warning everyone it's time to get out now. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.